We've invested just over $1 billion in 120 something funds over the last 12, 13 years. We were set up with £600 million on our balance sheet. 400 million of that was from the dormant accounts. A big part of what we've been trying to do is address the mental model that impact means concessionary returns and meet that head on with this idea that impact can drive commercial value as a practical business building strategy. I think we need everyone. And I think it also means trying to shift the bigger players in venture, so more of what they do is pointed in this direction. I think access enables picking because you then have the frame of reference to select well from. We are looking to achieve strong double-digit IRRs, and that's usually commensurate with something in the region of 3x net. Obviously, we know a small portion of funds, 5% perhaps, 10% maybe, achieve that in reality.
Today, I'd love to chat about a lot of different topics. First, to talk about how you evaluate funds and select funds at Better Society. I want to talk about portfolio construction. How does that work from an LP perspective? You don't want to, I guess, have all of your eggs in the same basket. Your role as an LP in the European VC ecosystem. Some of the trends you see as well, right? Because you get to see that before others, usually 2 years before. Talk about performance. I know it's a tough topic in impact, so let's see what's there. And also, where are the gaps and opportunities that you see? So does that sound like a good agenda for you?
Yeah, fantastic. We'd love to get into that, and thanks for having me on.
This episode is brought to you by Accelerating Impact, a non-profit that drives impact finance by running free accelerator program to support emerging impact managers. By joining them, you will get coaching, training, financial support, and access to a strong community of emerging managers. Sign up at the link in the description, and thank you to Accelerating Impact for supporting this episode. Look, let's start there. Give me a little bit of context.
But yeah, so Better Society Capital was set up 12, 13 years ago, originally called Big Society Capital, with a mission to channel more money towards tackling social issues and inequalities in the UK. And we do that in two ways. One is investing in funds, private market funds with a social impact element of what they do in the UK. And another is market stewardship activities, which include network building, thought leadership, policy, advocacy, convening, all sorts of various activities in that side of what we do. To give you a sense of some of the key numbers around that, and then happy to dig into how we look at that. We've invested just over $1 billion in 120 something funds over the last 12, 13 years. And in that time, the part of the market we define as the impact investing market in the UK, the bit we're trying to grow effectively, has grown 12 times in those 12 years. As I said, it's social impact focused in the UK. That comes also with a particular focus for us around disadvantaged and underserved groups. So that's quite a specific take on what impact is and means. And that's a function of the mandate we were set up with. And that has implications for how we source, select, analyze funds in different ways. The venture part of what we do is about 20% of our portfolio at the moment. It's one of four major investing areas for us, the others being housing, social lending, and social outcomes contracts. And that's the venture part is where I come into the picture. So I run that part of our program. We're in 24 live venture funds currently across a range of different stages and strategies, and happy to get into that on the portfolio construction piece. In fact, guided by you, where would you most like to start as we unpack that?
The first thing, I guess, is on where does the money come from? Because you also have a very, very particular way of getting money into your LP structure. Where does that come from?
Yeah, so we were set up with £600 million on our balance sheet. 400 million of that was from the dormant accounts. So this is a dynamic where if you had an account that you didn't access or didn't use or forgot about for long enough, it gets aggregated by the UK government. And if you remember, you can write them a letter and they'll send you it back. But for those that don't, and there are various structural reasons why people won't, that money is allocated towards good causes. and there's billions of this stuff. We got 400 million of it at the start, and that's where parts of our mandate around UK orientation and the types of impact we're prioritizing sort of flow from that in different ways. And we also have 200 million in 450 million chunks from the 4 high street banks in the UK, which came 2012 kind of post-crash. And they're our shareholders effectively. And we've had a couple of other top-ups and additional bits since, but that remains the core of our balance sheet, where we are ourselves effectively an evergreen vehicle investing off that balance sheet at a continuous flow in a way that, should it return what we expect it will return, we can do that indefinitely.
Quick, stupid question, but if I have a dormant account, forget about it for 20 years, gets into the fund does 3x. Do I receive 3x the money?
So where the money goes when we return it, and we are 12, 13 years into this, and as you know, private market funds are 10, 15 years long, so we're just starting to see some of these distributions. That flows into effectively towards our shareholders. And our shareholders are high street banks, but also a group called the Oversight Trust, which represents the dormant account monies. And that is recycled towards our mission, effectively. And we are shortly coming upon the point where there will be a hopefully significant amount of some of that. And that'll be something for us to think about how best we can use those recycled flows.
Really interesting. I guess I'd love to talk about your role in the ecosystem. I was looking at your portfolio, and it's interesting because in your portfolio, I found some funds that are, I would say, top tier, number one in their market, that I'm sure don't get any issue in terms of like getting liquidity into their funds. And I also found some others where actually they were quite emerging managers or like young funds, some of them of which like you finance a majority of the fund, like a very large share of it. So what's your role? Are you trying to catalyze the new fund managers and help them grow? Or are you trying to push the big funds and established funds into doing more impact?
Yeah, great question. And you're right to say there's a mix of this across the portfolio, as we have different, effectively systems change strategies that we're trying to pursue to tilt venture as a whole further towards impact. And maybe to contextualize that with our broader goals in venture first, and then it'll make more sense as we dive into some of the specifics. So what we're effectively looking to do is nurture an ecosystem that can itself nurture innovative ways of tackling social problems through technology. And we think that involves looking for things where two things are true. Firstly, tech can drive positive impact, which we think is not true always and everywhere, but where it is true is very, very true, and true in ways that mean they can deliver differentiated impact to other kinds of investment.
What are the places where that statement is accurate?
So we think there's some characteristics, and in our kind of internal lingo, we call this the venture way of making change, where there's a user centricity to how the problem is identified and solved. Secondly, there's data around engagement and usage, or whatever it might be, that can guide you towards finding product market fit, or product market mission fit, even in an impact context. And then thirdly, it's highly scalable through low marginal cost or other structures that are often true of tech-enabled business models. And we think where those three things are true, and where there is the right intent and the right sort of business model around that, you can deliver outsized impact. And we think in areas like health, mental health, financial inclusion, education, employment, there are some really interesting use cases for that. And actually, those are the areas that the other of the two things that we're looking for, we think is also true, which is that focusing on impact can drive commercial performance as well. So tech drives impact can drive commercial performance. And where those two things are true, you can build really big impact companies that can be transformative for impacting on people, but also transforming the systems in which they operate.
And for that, I guess you then need a mix of funds, because obviously you don't invest directly into companies, or at least not in your role. So that's why you need a mix of different funds at different level, I guess, of the stages, but also like establishment, I guess, in the market. So that's why you want to have both the emerging managers and the established players.
Effectively, yes. So while we're trying to find the places where these two things are true and grow these really big companies, make a really big impact, we think there's a few ways we can do that. One of them is investing in funds in different ways. Secondly, working with those funds and their portfolio companies and doing impact really well. And thirdly, building the movement around impact. And those are our activities, as it were, that feed into that theory of systemic change or systems change, where we are hoping to work with and support fund managers that can be great partners to impact companies, both as commercial business builders and as impact partners, advisors, mentors, etc. And we think one of the ways you can get there is by backing emerging managers who are deeply imbued with impact and deeply in the impact space, and building and demonstrating the credibility they have around the commercial side. And that describes probably traditional impact investing and a significant part of our portfolio over the last 12, 13 years. The other strategy that we've been pursuing in addition to that for the last 6 years or so is working with more established mainstream commercial managers who've backed things that we and they think are impactful, and they want to get sharper at impact as one part of how they source, select, support companies, etc. And effectively, through those two different lenses, we're looking to try and support a group of managers that's really good at both. And sometimes that means backing emerging managers with a deep impact focus. And sometimes it means backing these big, or not necessarily big, but established firms. Some of those are relatively boutique seed stage specialists, and some of those can be quite big platform firms. So there's different approaches in there.
I'll go with a name because it was in your website, so no shame in saying that. But when you go to a Balderton, for example, and tell them, hey guys, like you need to do impact, how do they react and how does that land within their strategy? Because one of the things, and maybe I'm super naive on that, but like sometimes I wonder, why would you not try and have a positive impact on the world? And obviously that means a lot of different things for a lot of different people, right? But from climate to social justice, basically you have a lot to cover. And still I see a lot of funds that are still just doing B2B SaaS software. And I'm like, why? So I'm curious to hear a bit of your conversation with like the Balderton of the world when you tell them, hey guys, we're going to do impact together.
So maybe a broader comment initially is I think a lot of VCs, not all VCs, but I think a lot of VCs get into venture capital to build a better world for their kids or for society, or just to improve the direction they think the world is going. And that motivation sometimes overlaps with the kind of impact that we might be looking for as an investor, or the impact that other investors might be looking for. But I think there is a real undercurrent of almost stealth impact investor mindset within the broader VC ecosystem. So to your point, I think people are trying to make the world better, whether they are backing health tech startups or things that are trying to improve AI infrastructure. And the former is probably something we're quite interested in investing in, and the latter is less of a fit for how BSC looks at the world, most likely. But that doesn't mean it's bad for the world. It's still a positive thing. So the conversations we have with firms like a Balderton or some of these sort of established mainstream names in venture, there's a number that we've invested with, and a larger number that we've spoken to over the years about this, are less, we think you should do impact, and more working with those that are to some extent already doing it, but not using the language around it, or not using the same granularity of practice and process and structure to analyze and drive the most value through how they do some of those things. Because really it's value at the end of the day. The point of process is value. And it's therefore less convincing or influencing, and more finding VCs who already want to do this stuff and helping them go on that journey.
That's interesting. And where do you see the biggest impact for you? Do you think it's emerging managers, or trying to change the mindset of the established players?
That's a really good question. So the slightly cop-out answer is I think we need both. Fundamentally, the size of problems we're facing, the amount of capital and expertise we will need to build businesses to solve those things, I think we need everyone. And that means working with emerging managers to catalyze new approaches, deeper impact approaches, focus on particular areas that might be overlooked. And I think it also means trying to shift the bigger players in venture, so more of what they do is pointed in this direction. Which of those will have the more significant outcome over the long term? I mean, feedback loops in venture are famously very long.
Yeah.
But maybe one way of answering that question is there are broadly three reasons why we started this systems change strategy of working with more established players as well. Firstly was working with people who knew how to build big businesses, to build big impact businesses. And we are starting to see that play through in our portfolio in this way.
And I think on this one, I think there are some funds that are trying to be more impact activist to some extent and financing startups that will have a hard time to scale. I guess my take on it, and I would want to see if you agree with me, but it's like, if you want to have large impact, go and build a commercial scale company that can, scale into the billions of dollar valuations, and also in terms of like revenue. And if you do that well, and if the company keeps the impact at the core, it might be better than I guess I think about it in terms of like almost like a unit economics, but for impact. You might have amazing unit economics at a small scale, but if you stay small, the additionality of all of that stays very small. Whereas if you have, I guess, a lower impact, but at a much larger scale, then all of a sudden it starts to make sense. Is that your understanding of it as well?
So it comes back to the two things we're looking for, I suppose, around tech driving impact and impact driving value. We're looking for places where you can build these really big companies that are having a significant impact. And I do think that means scale in the vast majority of cases. And scale can mean different things. Scale in the context of preventative healthcare can be quite different from the context of a particular acute healthcare intervention. So there's not one absolute number that equals scale, but the ambition and the mindset of commercial scale and impact scale hand in hand, I think, is core to how impact does and should happen in venture. That's not necessarily true in other asset classes. In fact, I think not true in other asset classes, but definitely true in venture. And I think we see that play out so there's some language you use at BSC, that impact as a driver of value. And that's what we are looking for at the heart of some of this, which is where doing impact in a high integrity way at the heart of how you operate as a company at the startup level drives commercial outcomes through engaging with talent, with customers, with regulators, with other investors. And actually, we released a paper on this last week that unpacks some of those levers in different ways.
I'll link to that in the description.
Oh yeah, fantastic. And there's some really good kind of data and quotes from others coming in. So it's not part of the point of doing that work as a working group through the Impact VC community is that this is a view that is, I think, increasingly common in the venture world, though the data on returns obviously is lagging. So at this point, it's a partially proven hypothesis, but I think there's a lot of really interesting thinking and emerging evidence that this is true in certain areas, and finding those areas and building big businesses in those areas, I think, is a really important part of impact investing effectively in venture.
Yeah, and what I like about this conversation is that as an LP, you also get to drive a little bit the conversation. I mean, it's also true for GPs because you get to invest in startups at the end of the day, which is what drives value. But the one thing is, like, if you go out in the market and say, we want to raise an impact fund, and no one listens to you, that's difficult. Whereas where you sit right now, you actually can influence others in trying to understand that narrative that impacts drives value, which I think is quite unique.
Potentially, that's one of the things we're really trying to do in terms of I mentioned various systems change strategies. A big part of what we've been trying to do is address the mental model that impact means concessionary returns, and meet that head on with this idea that impact can drive commercial value as a practical business building strategy, effectively, and working with GPs who have particular takes on that to explore. I mean, one way of thinking about our portfolio is a set of experiments, or one big experiment around where and how is this true, and finding people that want to go on that journey or have a view already around where they think that's true and how they're going to invest behind it.
I love that. Well, just before talking about performance, because we start to get into it, but just before that, do you have any particular target in terms of returns on your side? And if that's the case, from your perspective, are you in a picking game in terms of trying to pick the right funds to do it with? Or is it an access game where you actually struggle to find the right partners to do it with?
In terms of the RLP investments with GPs?
Yeah.
I mean, we are approached by 80 to 100 firms a year in venture specifically looking to have an LP partnership with us. I think we have we always find ourselves having more things we would like to do than can do, given our capital constraints in different ways and team constraints in different ways. So I think the opportunities are very much there. Does that make it an access game or a picking game? I think for the most part, we don't struggle for allocation where we want to invest. And that's because we are quite, I hesitate to use the word unique, but maybe unique, maybe just different as an LP. with our impact focus, with our hands-on engagement model, with our evergreen structure ourselves, so you're not taking fundraising risk with us as an LP, and our ability to act potentially flexibly in certain circumstances, I think gives us an interesting sort of value prop for some of these funds. And many of the mainstream funds that we've invested with have been oversubscribed funds that we've gotten into because of the value add and the partnership we can bring in that way. So I think access is a big part of it. I think access enables picking because you then have the frame of reference to select well from. And I think that's one of the things that many LPs new to venture don't necessarily have that frame of reference of what great can look like for a GP or a VC fund. And building that frame of reference, I think, is a really key enabler of picking well. Then we know the power law is true at startup level in terms of returns. We know that's true at fund level as well. So one of the bars we hold ourselves to is looking to work with funds that are, or we believe can be, top quartile or even above from a commercial perspective, as well as driving that impact alongside that.
That's perfect segue into performance. What's the target for you when you're doing a fund investment? How soon do you want to see your money? How much of your money do you want to see back at the end of the fund? What does that look like?
So the headline in venture is we're pretty commercial about it. So BSC as a whole has a return target that sees us being sustainable into the long term. So marginally beating inflation effectively, or inflation plus a bit. And parts of our portfolio take more risk and have different return seeking objectives in the context of the impact and systems change those investments are trying to seek. In venture, we're looking to achieve market rate return. And we think it is possible to do that alongside delivering impact. And we think that will enable BSC sustainability in the long term, and also our ability to invest in other areas where that maybe is less true over time. So we're pretty commercial about it. And
when you say market rate, is that 3x?
So yeah, market rate's an interesting concept, isn't it? Changes and means different things to different people. But broadly, yes. We are looking to achieve strong double-digit IRRs, and that's usually commensurate with something in the region of 3x net. Obviously, we know a small portion of funds, 5% perhaps, 10% maybe, achieve that in reality, and we're hoping for a slightly higher hit rate than that in some of the funds that we select, but we fundamentally don't know yet if that would be the case. But that's the aim. We have to believe a fund can be performing at around that level.
But I'd love to ask you, I don't know how much you can share, but across your portfolio, let's say if you aggregate everything so that we don't name, but you probably have, like, it's been 10 to 12 years, so you already have some funds that are getting towards the end of the life of the funds. Is 2x realistic? Because I keep hearing, that's the thing, like, I don't know where the real market performance lies. Like, what's the average of the fund, right? So what do you see across your portfolio? Are you going to get there?
So one caveat to the data was we've been investing for 12 or 13 years, including in venture. So our first venture investments were 2012, 2013. But we really built the program in earnest from 2019 onwards. So the vast majority even of funds we've invested in are sort of 6 years or younger. So actually a lot of that is not at the point where it's yet meaningful from a predictive perspective where those funds are going to end up, and a lot of it is not realized yet. So that caveat aside, probably 2 data points that might be interesting. One is when you look at the startup level on a look-through basis underneath these funds, and you look at what we consider impact companies from a BSE definition and all other companies, the two are performing about the same on gross multiple on invested capital. And that's a data point that is similar to those we hear from other LPs, actually. So we heard similar data points or sentiments in recent podcasts we did with folks from the EIF and folks from Isomer, who have much larger portfolios than we do as well. So we think directionally, impact can achieve returns that are similar to broader venture at that startup level. And then the second data point I mentioned in terms of our portfolio, so obviously there's a dispersion of returns there across those funds. There are funds in our portfolio that would be top decile based on their vintage. There are some that are top quartile, there are some that are doing a little bit less well than that. But as I say, it's not yet at the point where it's definitively material because of the vintages and the degree of realization.
So the story that impact doesn't drive returns is not quite accurate.
I think to give a categorical answer to that, we need to see some of the data really come through over the next 5 to 10 years. My personal view is that there are levers by which focusing on impact can drive business building success. And through that, impact as an investment strategy, particularly in some of the sectors I talked about, can drive impact and commercial return together. But that remains a partially proven hypothesis.
Very interesting. Well, I guess to transition to a bit of the conversation we had earlier around funds. So in order to drive that 3x net, which is your target, and you have to pick from this 80 to 100 funds per year that apply to your program or to funding. How do you go from 80 to what, 10 maybe, a little less? What goes into that process and what are you looking for? Because I guess that's something where I wish more LPs were vocal about, because that would help the ecosystem move forward and help GPs align to expectations.
So in terms of the funnel, 80 to 100 a year in that kind of top of funnel piece, we make 3 to 5 fund investments per year. Often, as we have a number of funds or firms we've invested with before, often 1 or 2 of those are new funds. So the funnel's actually even more aggressive than that for new fund managers. How does that work? There's an eligibility screen because we have quite a specific take on what impact means for us, as I mentioned at the start. That's often the first key conversation is the sorts of impact BSC is looking for in terms of the social impact in the UK for disadvantaged and underserved groups, and how much that overlaps with the sorts of thing the fund's going to be investing in.
How many funds do you remove from there already? About a half? Less?
Probably half or more. It's quite a significant group, and actually particularly in recent years with large parts of the impact ecosystem investing in climate, that's an area we're less active given the social impact focus of what we do. That does mean quite a significant number of that group don't have significant overlap with the area we're most interested in, but some do, and a lot still do, and it's a bit of a judgment as to where the lines are on some of those things. Then once we're into a set of prospects that we look at in earnest, and we're probably talking a few dozen here a year, we assess them across a few different things. So every investment we make at BSC is invested in with analysis against financial risk return, impact risk return, and systems change. And the way that translates in venture is that we look at the venture skills and the impact skills. The impact skills we break down into impact, effectively mindset and overlap and engagement with impact as a concept and the way that shows up in people's thesis. So sort of impact strategy, I suppose. Secondly, impact practice and process, how that shows up in the value chain of venture and how you source, select, win, support, exit, etc. And then thirdly, impact performance. So to what extent have funds invested in things that have delivered significant positive impact on people already? And that's not always true for emerging managers in particular, but that's a piece that we look at if it's there. So strategy, process, and performance on the impact side. On the venture skills side, we break that down into 3 things also. Firstly, understanding the strategy and how that's going to deliver commercial returns as well as impact. Secondly, edge and how well set up that fund manager is to deliver that strategy. And thirdly, repeatability. So how consistently can they apply that edge in a high quality way over time? And that's where a lot of things like process, team building, firm building, portfolio construction, et cetera, start to play through as well. And actually I haven't mentioned this specifically, but probably the most important thing for us is values alignment and looking for people who are those that we feel will make choices we will be proud of in the long term and have shared values for the way that we want to show up in the world.
On that last part on repeatability, it's interesting because I had never heard of that concept from an LP perspective. Do you think there are ways that as a GP, you're not able to repeat the same strategy all over again? Do you think there are areas where you might have an edge for a couple of investments, but then you're done? Is that what I understand from you?
So I think so when we talk about repeatability, there's an element of that. So it doesn't necessarily mean applying the same strategy again and again and again, but often there is some evolution around a core strategy, but there is still a core element of that thesis that persists. What I think we're talking about there is demonstrating edge. And perhaps you could imagine a life cycle where in the first couple of years of an emerging manager being set up, they have more edge than they can demonstrate because there's not the track record to look for there. And in maybe 10, 15 years later, in some funds cases, there's strong evidence there, and maybe even 5 to 15 is the right time frame here. There is evidence of that edge, and it's still relevant given the market conditions are similar and these sorts of pieces. But perhaps you run a decade or more, or 2 decades or more later, succession may or may not play out in that firm. There may be a strong brand and strong perception of edge, but the real edge may be somewhat less than that. So this differential between actual edge and sort of visible edge, as it were, I think is a really complex thing to analyze. And repeatability for us kind of gets at that to some extent. That's where some of this, as I say, sort of firm building process elements really come in quite strongly.
You're basically trying to de-risk the fact that a firm could rely only on a couple of people that have that edge and not the brand.
Yeah, potentially. I think that's one way of looking at it. I think another way of looking at it is it's about compounding success through time, and having a clear process that enables learning and iteration over time is more likely to build compounding success. And it's about understanding that generational outcomes in venture happen on a time frame of decades. So having a firm set up that can persist through that period of time, though that clearly isn't the goal for everybody, and lots of funds don't make it that far. But I think having that desire to not just make a few investments, but to build a fund, and not just build a fund, but build a firm, is a key part in how we look to select what we consider great GPs.
If we go back to selecting funds, what makes a great team for you? When we think about investing in an impact fund, like what do you want to see actually in terms of the profiles?
This is a really good question. And this is one of those things that I think sits at the heart of venture, where people talk about people being the most important thing, but actually don't analyze it scientifically as they could. And we're probably to some extent guilty of that ourselves. The sorts of things we're looking for are that impact intent piece, the desire to make a real difference in the world from an intrinsic deep motivation. We're looking for that commercial mindset, often quite an entrepreneurial mindset. It can sometimes a shorthand of having that kind of founder energy around the thing that you're trying to build as a firm, and the way you engage with folks, I think is one of the things we've seen be a real success factor for fund managers we back, particularly emerging managers. And a piece around maybe you frame it as learning, maybe you frame it as process orientation, but something there about trying to continuously improve and build those compounding advantages and flywheels where you can, individually and as a firm. Maybe some might call that growth mindset in different ways. I think that's a really key, being a bit of a learning engine is a key part of it as well.
Which I feel like goes hand in hand with the entrepreneurial mindset as well. It's kind of the same idea of like always trying to push a bit further ahead.
Yeah, absolutely. And find those frontiers. And I guess venture as a whole is maybe or one way of thinking about it is potentially as a engine for experimentation around what business models can exist. And it's very good at finding new things as a system, and finding people that are right at the frontier of that, I think is part of doing that well.
Let's unpack the motivation component a little bit. Do you actually look for moments or specific, because I guess, for example, you have quite a social aspect to you, or actually your thesis is about social impact. Do you want to look for a deep understanding of what it means to be underrepresented, to be in poor financial conditions, or whatever like that part means? Is that what you're looking for? People that really resonates with that?
In part, yes. And that doesn't necessarily mean everybody has lived experience of that, though a significant number of the GPs that we back do have lived experience of that in different ways. I think for a VC to be a really valuable partner to the firms that are tackling problems that improve the lives of people experiencing some of the things you've talked about, I think there is a need for deep empathy and understanding of that problem and understanding of what a solution can look like. And to do that well, I think that often entails either lived experience or a set of values, behaviors, mindset, etc., that let people build that. And I guess when people are talking about impact intent, that's sort of a shorthand for some of that mindset.
Look, let's transition into like the trends that you see in the ecosystem. You've been part of it for a very long time. Impact as a concept is having a time. right? Don't know how to better call it. Um, do you still see a lot of impact funds? Do you see other LPs also resonating with that mission? Or are we in an environment which is much tougher for impact funds?
I think we're in an environment from a fundraising perspective that's tough for all funds at the moment. And it's hard to disaggregate that from how impact funds are finding it. I mean, obviously there's negative sentiment around ESG, EDI, impact to some extent, climate within that maybe to a larger extent. For the most part, we've seen that as rhetoric rather than action. And often people are still acting in ways, doing the things that drive impact. And they may or may not be using impact language anymore to talk about that. But for the most part, at least in what we're seeing, people are still doing it, still investing behind that in different ways. Some folks are even doubling down on that language and treating that as a sort of differentiated statement, perhaps to a greater extent than they were a few years ago even. While others are moving away from the language but still acting on it, and potentially some are moving away from the language and not doing it anymore. That we're not seeing so much of that in our direct experience right now. A number of funds that we think that we've invested with, a number of funds that we haven't invested with, but we think are doing a really great job, don't necessarily call themselves impact funds. They might call themselves a health fund or a climate fund or a consumer fund, but fundamentally are set up to and select for and support specifically around impact in different ways and topics we would consider impactful.
For the funds that are doubling down right now on impact, do you think that's a good strategy? Just like going against what other people are doing? Because I feel like sometimes in venture, you just have to be different. Otherwise, it doesn't work.
I think difference can be a powerful strategy in venture in general. I think one way of thinking about it is that VCs have two core constituents, one being their investors, their own LPs, and one being the founders they're looking to invest with. And I think if you have a way of investing and authentic messaging and way of showing up in the world that resonates with the founders you want to back and the investors you want to back you, then that's a really powerful thing. And for some folks, that means leaning into some of this language. And for them, I think that's a really powerful thing to do. But I can also see why for other firms that might be making lots of investments we think are impactful and fundamentally doing the job to make a positive difference in the world, might use a different language to enable them to have that success. And I'm sort of okay with that too, actually. We care about the outcomes, and language and process and practice are all in service of that. So to your point around impact meaning different things to different people, I think impact is a spectrum rather than a binary thing. It's not so much that something is impact or isn't, there's different kinds of it. And maybe drawing on a concept from the gin, they look at impact, intentionality, measurability, and additionality. And what we would consider an impact fund is not a million miles away from that. You're seeking to have a positive impact in the world. You are attempting to understand that through measurement to some degree. And actually that can be a pretty lean degree. And you're attempting to make a difference that wasn't going to happen otherwise. And I think many venture firms won't necessarily use those words, but will articulate those concepts. And for us, that's, if they're doing it, they count as an impact fund for us.
And it's also the later part of what you said is very interesting for VC, because I think investing in companies that would not have been financed otherwise is a strategy to deliver outsized returns, because you're not just going after whatever everyone else is investing in and just like you can actually deliver alpha because you're doing things that others are not doing. So like even just purely from a financial perspective, that is also a good strategy.
Yes, and things that others aren't doing or earlier than they're doing them. And I think particularly the latter can be particularly powerful.
For sure. Well, look, something else I wanted to explore briefly on the trends. I guess Europe is quite famous for having a hard time exiting companies. From where you sit, do you think that statement and story is true, or do you actually see exits across your portfolio, and do you think we're in a good shape?
I think venture as a whole is struggling with liquidity at the moment everywhere in the world. And part of that is this European narrative. In our portfolio, as I mentioned, the majority of it is 6 years old or younger. So you wouldn't necessarily expect DPI from that portfolio, actually. We're starting to see some positive exits there, delivering DPI of sort of between 0.5x and 1x the fund size, which is useful, meaningful DPI to be delivering. But we are not yet seeing, and I think this is a function of vintage more than anything else, the realized returns at the sort of multiples you would hope for by the end of the fund life. And I mean, maybe a broader comment is I think we are not seeing the IPOs in Europe that perhaps you might see in the US or other places. And I think we are more seeing, in our experience as an LP anyway, M&A and to some extent secondaries. That's maybe a vintage thing. That's maybe a Europe thing. I don't think we necessarily have data points to pull it apart just yet.
Maybe one last thing to touch on before we close this episode is on fund models. I see a trend in emerging like solo GPs, for example, is something I see a lot. I see a gap in growth funds. That's also something I see a lot. But are there areas that you're seeing as an LP that I'm not, like that other people in the market are not seeing yet?
Yeah, interesting question. I think I'd share your observations. We're seeing more solo GPs come through. That's something we've not invested behind historically, but are actively exploring doing so. I agree there's a growth stage gap there in general, but particularly for impact funds and impact funding. And that, to your point around exits we were just talking about, presents a challenge for impact sustainment through the life of a holding period or the fund as a whole. So those are two gaps that, or two dynamics we're definitely seeing. I think we are more broadly seeing a bifurcation between really large platform funds and smaller, more boutique funds that are playing at earlier stages with particular specialisms or strategies. And I think AI as a tool to help people deliver funds is enabling both ends of that, actually, and possibly pushing that bifurcation to some extent. The part of that we are more excited about is the earlier stage, smaller, specialized funds with particularly thought through theses. And that's potentially a function of the areas we're looking to play from an impact perspective, potentially a function of what the European venture ecosystem has traditionally looked like and done well. And so where we see opportunity at the moment is more in that space, actually. And particularly in the context of some of the areas I mentioned, we're particularly excited about health and particularly excited about economic opportunity. And in health, that particularly means areas like prevention and workforce efficiency, trying to tackle some of the supply and demand challenges in health more broadly. Parts of that obviously are very AI related, parts of it are other technologies. And within the economic opportunity side, fintech is a big part of that for us, inclusive fintech. There was a really interesting wave there around machine learning applied to open banking in the UK. I think we may see another wave, may be seeing another wave where AI allows or opens up opportunities through more attractive cost base or personalization or these sorts of elements in the finance realm that I think could be really interesting. And obviously there's big positive and negative implications of AI for education and employment. And I think that's a really interesting and important place where perhaps some of the business models are a little bit less developed right now, but where I think we would like to see a good amount of impact-oriented activity, because there's obviously significant impact risk there as well as impact return potential.
For sure, yeah. And definitely with your thesis, it's quite contradictory, right? Like you want to help people get more jobs, but equally AI might take over some of those jobs. But well, look, we are at the end of this episode. I really enjoyed the conversation. I think maybe I want to ask you this before we finish this episode is what's one idea or like a concept or an advice maybe for fund managers today that are raising money?
I think the fund managers we see have the most success in fundraising in the impact space have a few characteristics, which are or include having a very clear sense of the impact they want to make. And often that's transformative, high ambition impact, being able to articulate that really clearly. Secondly, articulating how delivering that impact will drive commercial returns also. And thirdly, articulating how that fund manager is uniquely well set up to do that. And I think having a really compelling narrative around that is a really key piece. I think there's also a process element where you can really tell which GPs are enjoying fundraising and which are not. And maybe nobody enjoys it, and the ones that appear they are have learned to present in that way. But I think enjoying the journey, enjoying the process, there's going to be ups and downs and challenge and pain along that journey, but really engaging with that in a thorough, process-oriented way and recognizing that what you are doing is providing an opportunity for LPs to help deliver their goals by investing with you. and that's a really powerful thing you're offering them as well. And having that intrinsic sense of value as you navigate that quite challenging process, I think can be I mean, I say that having never done it myself, so take it with a pinch of salt, but the folks I've seen do it well, I think bring some of that energy.
Yeah, I'll ask around the folks at the Impact Week if anyone really enjoys fundraising. And by the way, before we finish this episode, I should also say thank you to Norskin and Impact Week for having us in their beautiful office. Well, look, if people want to reach out after this episode, where can they find you online? What's the easiest way?
So I'm on LinkedIn. I think I'm slightly more formal on LinkedIn. So I'm Douglas Sloan on LinkedIn, but people call me Dougie, so feel free to folks to do that. I think the other place, we talked less about it in this conversation actually, but a big chunk of my time now is also the Impact VC community, which is at impactvc.co. We talked about BSC's investment strategy and the UK social impact focus there. Impact VC is a community of VCs operating globally. It's social and environmental in focus. We run events, we build resources together, we run training for VCs around impact. That is I think, really good way of getting up to speed on impact, finding people who are going on this impact journey, and kind of deepening expertise on that if folks would like to do that. So I would suggest impactvc.co for those folks.
I'll put the link in the description, and definitely a great community and also free community, right? Like it was mentioning it that all of what you just mentioned is free. Cool. And then one last question for you today. If I were to talk to another LP, mostly in climate, who should that be?
So I think some of the really thoughtful LPs in the climate space. I mean, Jacqueline van den Ende at Carbon Equity, I think is really thoughtful on this. The EIF have obviously invested significantly behind this. I mean, Cyril Griffiths and his team there have done some really good thinking about impact more broadly, including the social side as well as the climate side. I think the Isomer Capital team are very good investors in venture more broadly and wouldn't necessarily call themselves impact investors, but have backed a number of funds that are impactful and I think are thoughtful about the dynamics between impact and the commercial side, including in the climate area. So I'd maybe shout out those three top of mind. And actually, for LP-driven thought leadership on climate, the Esme Fairbairn Foundation and Johnny Page there, I think, is a real expert on natural capital and a number of other climate-oriented areas in venture and more broadly. So I would encourage checking out some of the things that he's published too.
I love that. Well, thank you so much, Dougie, for today. It was a pleasure. For people that stick through the end of this episode, don't forget to like, comment, and subscribe if you're on YouTube, or to give us a follow and a 5-star review on Apple Podcasts and Spotify. Dougie, this was a pleasure. Thank you so much.
Fantastic. Thank you. Really enjoyed it.